Yesterday was a rough day for Lumentum Holdings, the company behind the ticker symbol LITE. The stock dropped about 14.19% in a single day after the company issued disappointing forward guidance, and this decline happened during a broader pullback in technology stocks, with the Nasdaq Composite falling about 2.06%. So, what exactly happened here? Why did the stock drop so sharply after such a strong multi-year rally? And what do analysts think about where the stock could go next? Let's break it down. First, let's quickly talk about what the company actually does. Lumentum Holdings is a technology company that focuses on optical and photonic components. These technologies transmit and process information using light rather than electrical signals. In simple terms, Lumentum produces critical components used in fiber optic networks, data centers, telecom infrastructure, and advanced sensing systems. Its products enable high-speed data transmission, which is essential for modern internet infrastructure. As global data traffic grows rapidly, driven by cloud computing, AI workloads, and streaming services, demand for faster optical networking equipment has increased significantly. Lumentum also produces laser and sensing technologies used in industrial manufacturing, semiconductor equipment, and advanced electronic systems. Because of these applications, the company sits at the intersection of several powerful long-term technology trends. And that helps explain why the stock has performed so well over the past several years. Over the last 5 years, LITE stock has increased by roughly 548%. That is an extraordinary run, even compared with many other technology companies. A big part of this rally has been driven by growing investor excitement around AI infrastructure and next-generation optical networking. As companies build larger AI data centers and require faster connectivity between GPUs and servers, the demand for high-performance optical interconnects has increased dramatically. Companies like Lumentum provide key components that enable those high-speed data connections. More recently, the company received an additional boost after reports of a major supply deal with the AI chip giant Nvidia. According to reports, Lumentum secured a $2 billion supply agreement with Nvidia to accelerate photonics production, supporting demand through fiscal year 2027. This deal increased investor confidence that the company could play an important role in the AI hardware ecosystem. This news helped push the stock higher in recent months and led many analysts to raise their price targets. However, when expectations rise quickly, stocks can become extremely sensitive to any negative surprises. And that brings us to why the stock dropped so much yesterday. While the company reported its latest earnings results, management issued weaker-than-expected forward guidance. In other words, the company indicated that near-term revenue growth may not be as strong as investors had hoped. There are a few factors that may be contributing to this. First, the telecommunications and networking equipment industries often move in cycles. Customers may place large orders during one period and then slow spending while working through inventory. Second, some analysts believe parts of the optical networking supply chain may still be dealing with inventory adjustments, which can temporarily reduce demand. And finally, when a stock has already rallied dramatically and is trading at high valuation multiples, the market tends to react strongly to even small changes in expectations. This leads to an important point about valuation. Even before the recent drop, Lumentum was trading at very aggressive levels. The stock's forward price-to-earnings ratio is around 86, and its price-to-sales ratio is about 23.76. For comparison, many established technology companies trade at price-to-sales ratios between 5 and 10, and forward P/E ratios closer to 20 to 35. That means investors have been paying a large premium for Lumentum's expected future growth. Now let's take a closer look at what analysts are saying about the stock. Despite yesterday's sharp drop, many analysts remain bullish on the company's long-term prospects. As of March 7, 2026, the stock carries a moderate buy or outperform consensus rating, and analysts have actually been raising their price targets significantly in recent weeks. Current 12-month price target estimates vary widely. The average price target is roughly between $632 and $658 per share, depending on the analyst group. The highest target price sits around $900, while the lowest estimate is about $455. Several major analyst upgrades came within the past few days. Rosenblatt Securities raised its price target to $900, up from $580 previously, citing what it believes could be an optics industry supercycle. Needham and Company increased its target to $850 on March 4th while maintaining a buy rating. Stifel raised its target price to $800, also maintaining a buy rating. Meanwhile, Barclays increased its price target to $750 while maintaining an equal weight rating, suggesting a more neutral outlook. And Argus Research raised its target to $729. At the time of the latest data, the stock's last closing price was around $558 per share. So based on those average targets, analysts still see potential upside from current levels, assuming the company continues benefiting from strong demand in optical networking and AI infrastructure. However, there are also a few cautionary signals investors should keep in mind. One point some analysts highlighted is recent insider selling by the company's CFO. Insider selling does not always mean something negative, but it can sometimes raise questions after a major stock rally. Now let me share my personal view on the stock. In my opinion, this pullback is not particularly surprising. When a company's stock rises more than 500% over 5 years, the market tends to build extremely high expectations. At the same time, the current valuation metrics still look quite stretched. A forward P/E ratio above 86 and a price-to-sales ratio near 24 suggest investors are paying a large premium for future growth. For that valuation to be justified, the company would likely need to deliver very strong and consistent revenue and earnings growth for many years. While the long-term demand for optical networking and AI infrastructure looks promising, growth in these industries can still be cyclical in the short term. So, in my view, this recent pullback could simply be the market adjusting expectations after an extremely strong rally. That doesn't necessarily mean the company itself is weak. Lumentum still operates in a very strategic part of the technology ecosystem, especially as AI infrastructure expands. But investors should consider whether the current price already reflects a large portion of that long-term growth opportunity. Thank you so much for watching this video. If you found this analysis helpful, please consider liking the video and subscribing to the channel for more content about stocks, markets, and long-term investing. And thank you again for your support, and I'll see you in the next video.